Hello viewers, I am Sanjeev Pandya welcoming you to a show called Tax Time. Your taxes matter. As you know, tax season has begun, and what do we need to know about taxes? I would say a whole lot more than you can imagine, because there have been tax reforms. Many new changes are going into effect starting from this year. They were actually approved by Congress and the Senate last year, but they're going into effect this year. So we all need to know whether you're filing a personal tax return or corporate tax return or any tax return, you must know what are the changes. So in this show right here on TV Asia, our aim is to give you a whole lot of information about the changes in the taxes. So that way you will know before you go to a CPA or an accountant, you will know what other changes are there and you will be aware of it. Now talk about CPA or accountant. Of course, you know that you need a knowledgeable and very experienced CPA and accountant, and I'm so happy to introduce you a person who has over 20 years of experience when it comes to bookkeeping, accounting, payroll services, and much more. He's going to join us in this series of Tax Time, and he's going to educate us and guide us when it comes to tax changes. Ladies and gentlemen, please help me to welcome Mr. Ajay Kumar, CPO, SAI CPA Services. Sir, welcome to the show.
Thank you, Sanjeevji. I appreciate the opportunity. With this show, the intent is we want to bring this whole information. We want to clear up the maze of the tax changes that this country has seen in 36 years. We have been practicing for over 20 years and we have not seen this type of changes in 1 year that we have this year.
Absolutely. So basically what you're saying is that you already have your plate full of all this information.
Well, tax season has been busy consistently all these years, but this year is different. This year is more about education, giving the right information to the clients, to the viewers. See, when you have a lot of these changes, and the changes are over 2,000 changes.
Acha, overall there are 2,000 changes.
In this year,
right.
Over 2,000 changes. Now, not every change is going to be applying to everybody. There are some changes related to the businesses, some changes related to individual taxes. But the key here is you have to know what applies to you. So you are well prepared. It's all about planning.
Correct.
So in any situation, when the market goes up, when the market goes down, or any changes happen, the key is to use that as an opportunity. How do I plan now to bring my tax liability down tomorrow?
Correct. Absolutely. That's the key thing. Now, obviously, you know, this is the time of the year where CPAs are very busy. We know that. And you, with over 20 years of experience and having so many clients, what's your general feeling when they call you, when they contact you? Are they really like, a little bit nervous, or they want to know more information when it comes to taxes? What's your general feeling?
I say people are apprehensive. Everybody knows the changes are happening.
Correct.
And people want to hear what they want to hear. So a lot of times they will read on the internet, they will read through friends, through families, oh, the property tax is going away. And not understanding the whole situation, they are getting more and more apprehensive. They are worried. They know the changes are happening. They know some of these changes are good for them and some of these changes are not good for them.
Okay.
But the key here is to understand what's good for me.
That's exactly what you said is the right set, because your clients, you said they are apprehensive, they are a bit confused, and they want to understand. So besides your clients, our viewers, TV Asia viewers, let's give them a complete knowledge of this, all the tax changes, and hopefully they will know also more about tax changes. Where do you want to begin from?
Let's start with taxable income. What's taxable? What's non-taxable? How do I plan for my taxes now, today, to create a difference in my tax liability tomorrow? See, as we were saying, these type of changes have not happened in many years. This country has not seen these type of changes in over 36 years. The key here is to understand, to plan, what's in it for me? What are the changes that are going to affect me? What's in my favor? What's not in my favor? Okay, there are a lot of talks about property taxes, but are you really affected by it?
So now let's just divide these two categories, taxable and non-taxable. What are the categories, what are the points in taxable category, and what are the things in non-taxable?
I'll give you some easy examples. A lot of people are not aware of it. Say tips. When you tip the bartender, when
or
you tip
the
waiter, waitress, that money that they are receiving is supposed to be taxable for them. When you are bartering, I do this for you, you do this for me.
Correct.
That income, the bartering income, is supposed to be taxable.
Fully 100%?
100% taxable income.
Really?
And government tracks it. When you exchange, can I give this to you and you give me that?
Correct.
That's taxable income.
Okay.
Up until December 31st, 2018, meaning as of last year, even the child alimony income is taxable income. So all the divorces that happened up until last year, for all of them, the alimony paid is tax deductible and alimony received is taxable income.
Okay. So let's just point out one thing, that before that, up to December 2017,
Right.
this was not taxable or tax deductible, right?
No, going forward it's not.
Right, going forward.
Up until December 31st, 2018, all the divorces that have happened up until last year, for them, the income received, alimony received,
Is taxable.
Is taxable.
Which was not taxable before.
Well, it was,
Okay.
but going forward, it's not going to be taxable.
Okay.
So all the divorces that are happening technically after January 1st, 2019,
Not taxable.
the alimony paid is not taxable, and alimony received is not taxable.
You think it's a good change?
Well, let's understand why they did it. I mean, if you think about it, one person is paying the alimony and it's tax deductible for them. One person who is receiving it, paying the taxes anyway. So why would the government care? One person is deducting, one person is paying.
Correct.
So you think about it and you say it should be a zero-sum game. Government doesn't care. But what happens, the person who's paying it typically makes more money.
Correct.
So they are in a higher income tax bracket.
Exactly.
The person who's receiving the alimony is typically in lower income tax bracket. So they pay low taxes. So there is an arbitrage that's created. Person who has more money is getting the reduction, and the person who has less money is paying the taxes. So government was losing a lot of money.
Right, exactly.
So going forward, in the new bill, after January 1st, 2019, this is one of the very few changes, Sanjeevji, that's effective January 1st, 2019.
Correct.
Most of the changes,
Correct.
90% plus changes are effective January 1st, 2018.
Exactly.
So all the divorces that have already happened, they are already grandfathered into it. So if somebody is getting the deduction, they will keep getting the deduction.
Okay.
But
All right.
going forward, all the divorces, the alimony is not deductible for the person who is paying it, and the person who is receiving it does not have to pay tax.
Nice. So once again, just to recap, in your taxable categories, you said tips and alimony that you mentioned, and the wages, of course. Wages are taxable also.
Right.
Okay. Exchange income.
Right.
What's exchange income and why is it taxable?
Well, exchange income typically is a form of bartering. I do this for, I have a loan mover.
Right.
He moves the loan, I do his taxes.
Okay, so bartering.
I don't pay him,
Ah.
he doesn't pay me.
Correct.
But I still have to report the tax preparation fees as my income.
Okay.
He needs to report
Your
for
CPA fees, so and
the
so
CPA
forth.
fees.
Correct.
The loan mover needs to report that the service fee as his income. So it's bartering, it's exchanging the services, but it's still taxable for both parties.
Okay, so exchange income in other form, it's a bartering.
Right.
Okay, with that note, we're going to take a break, and when we come back after this messages, we're going to look into non-taxable income and also many other important categories when it comes to tax changes. That's coming your way right after this message. Welcome back to the second segment, Your Taxes Matter show. As I mentioned in the beginning, this is going to be an informative show, an educational show. So all you viewers are going to get a lot of information when it comes to taxes and tax changes. And this is, of course, with the help of Mr. Ajay Kumar, CPA of SAI CPA Services.
Thank you,
Before
Sanjeev.
the break, we quickly mentioned taxable
Yes.
categories, the categories in taxable. Non-taxable में कौन-कौन सी है क्या है?
So there are some income. By default, all incomes are taxable. There are certain incomes that are not taxable. For example, welfare benefit
जी.
is not taxable.
It's a welfare, so
It's
obviously
welfare, as the name
exactly,
says.
Exactly.
Child support. So we were talking about the alimony. So alimony was taxable, but even during the earlier time, even before 2018, child support was never taxable.
अच्छा.
Child support is not taxable, right? Then there are other incomes, the adoption charges, scholarship. There are certain incomes that are not taxable, where the person who is receiving it, the cash benefit, damage rewards is big. If somebody happens to be in an accident and this person is getting some money, So all the damage rewards are not taxable, meaning I have to fix my car and I got some money back from the insurance company. Is that money taxable?
Okay, not
That's
taxable.
called damage reward. That's not taxable.
Damage rewards, I can understand that, but you have it here, on the slide, and I'm sure viewer can also see it on the screen. Cash rebates.
Right?
What kind of cash rebates are not taxable?
Well, if you buy this paper, you get $10 in the mail. Or if you buy this item or refrigerator, and if you fill up this coupon, you get $100 in the mail.
I see.
That's called cash rebate.
The reason it's not taxable because throughout the year, it's not like you're going to get a whole lot of money
It's not about the amount. It's not about the quantity.
Yes.
The way the government looks at it, if somebody is giving you $1,000 item and giving you $50 on cash rebate, in fact, they are selling it for $950. So the amount that you're getting back is actually taken out of the sales price.
Correct.
So it's really not, you wouldn't have bought it if it was $1,000.
And somewhere somebody has paid tax on the
Absolutely.
amount, so
Absolutely.
it cannot be double taxed,
Right,
basically.
right. Absolutely.
All right, so that's the taxable and non-taxable income categories that we discussed. Now let's go to obviously one of the most popular item on personalized individual tax deduction, standard deduction.
Absolutely. So under the new tax reform bill, as we said, there are a lot of changes. One of the main changes, personal exemption that used to be almost $4,000 per person is going away. So if you have a family of 4, you used to be able to deduct $16,000 plus, $16,200 as personal exemption. Going forward, the personal exemption is 0. But in lieu of the personal exemption, government has increased the standard deduction. Now, you think, why would the government do it? Why would they try to take one thing away and try to increase the standard deduction? The intent, the plan was, we want to make the taxes so easy so people don't have to itemize it. Right now, a lot of people itemize it. With this new tax reform bill, we are expecting that 90% people don't have to itemize their taxes. So the intent behind this change, the intent behind this rule is to make your taxes simple. Now, there are a lot of changes. When the changes started, the plan was to keep it simple. But with all these changes, as we were discussing, Sanjeevji, there are 2,000 plus changes in this tax reform bill. So it's not that easy anymore.
But this is one of the major changes.
This is
one of the major changes.
Absolutely.
And I'm sure that you can go back to many years. The personalized deduction was always there, and now standard deduction and the changes that they have made. This is one of the major changes.
Absolutely.
And when you say you don't have to itemize, even though itemized deduction is going to be there.
It will be.
It will be there. It will always be there because there are certain categories that go into itemized deduction form and everything. So it's going to be there. But they made it simplified that you really don't have to itemize.
Absolutely. And let's talk about the itemized deductions. There are a lot of itemized deductions that were allowed earlier that are not allowed anymore. Let's take an example. Property taxes. Property taxes were allowed 100% if you're itemizing it. Going forward, there is a limit. There is a cap of $10,000 on sold taxes. It's called state and local taxes, and property tax is considered as part of your local taxes.
Correct.
So a typical person in our area who works in the state, they pay some state taxes, then they pay some local taxes, some municipality taxes, including everything. The cap now is $10,000.
Now, that is something where I'm sure many people are going to be unhappy with that, because people living in a state like New Jersey or New York for that matter, and then other states where the cost of living is so high and it's so expensive to live in, and when you live in expensive house, bigger house, obviously real estate taxes are high. They're going to take a big hit because
in many cases.
In some cases, 10,000 is only 6 months tax.
Well, in many cases, 10,000 is only the state tax.
There you go.
So if somebody is living in New Jersey, for example, working in the state of New York, they are already paying more than $10,000 in the state income tax. For them, property tax deduction is 0. In New York, New Jersey, Connecticut, California, there are some states where the property taxes are notoriously high.
How are they going to get? How are they going to benefit? Is it something there where they can compensate, the loss?
Well, there are. So the plan is, at least the plan from the government was, to have everybody getting some sort of benefit. So the income tax brackets have changed. So the minimum income tax bracket was 10% and the highest was 39.6%. In this new tax reform bill, the highest income tax bracket have gone down from 39.6% to 37% now.
Okay.
So if you are making more than certain amount of money, you are paying 2.6% less taxes anyway. So this is in lieu of certain deductions that you will not be allowed going forward.
Okay, very nice. So now in the standard deduction category, let's just highlight individual. Individual 2017, it was $6,350,
Right.
and for 2018, it's going to be $12,000.
Absolutely. It's a little bit misleading depending on who you talk to. So 6,350 was the standard deduction for a single person. You add $4,050 as personal exemption on top of it, which is going away in lieu of increased standard deduction. So even though it sounds like we doubled the standard deduction, but the standard deduction is only going up from 6,350. Then you add $4,050 for the personal exemption.
It comes out. Yeah.
So it's almost 10,000,
It's
11,000 going to $12,000.
Exactly. But they simplified it. Let's put it that way.
Right,
So
right,
that's
right,
individual
absolutely.
and married filing single.
Right.
Right. For the same thing.
Absolutely.
It was 6,350 in 2017 and 12,000 in 2018.
Right.
With that note, we're going to take a break, and when we come back, we have actually somewhat information to give you in the standard deduction category, and that's all coming your way right after this messages. Welcome back to the third segment of the Tax Time, Your Taxes Matter show. In the first two segments, we start to give you just basic general idea on the tax law changes and tax reforms and whatnot, and there have been so many changes, and Mr. Ajay Kumar, CPA of SAI CPA Services, has been giving out quite a bit information. Break se pehle jo hum baat kar rahe the, obviously we stopped at individual and married filing single. Now married filing jointly or qualified widow.
Absolutely.
They also have same amount of standard deduction.
Well, the standard deduction for them is 24,000. So the perception is we are doubling the standard deduction, but actually it's not being doubled.
Correct.
If you add
It
the
just
personal
compensates
exemption,
from what was there.
and
It's not
a little
there.
bit more. It's been increased
It's a little bit more.
to discourage people so they can use the standard deduction as opposed to the itemized deduction.
And what about head of household?
Head of household has a different limit. It's 18,000 now for the standard deduction.
Correct.
And a lot of people who qualify for head of a household probably don't have to itemize, especially in light of not having a lot of expenses that can be itemized anymore.
Okay, that's what I want to ask you, because you mentioned that not everybody has to itemize, and you know, some things are in itemized, some things are not. Can you highlight a little bit of more when it comes to itemized deductions?
Absolutely. So all the itemized deductions go on Schedule A. Schedule A, if you remember, has 4 sections to it. Medical deduction for this year, for 2018, is only up to 7.5%. Starting next year, for 2019, medical deduction must be over 10% of your AGI. So just remember it. The second section is the SALT, the property taxes, which is capped at 10,000. So especially people who have bigger houses, they will have less reasons. They won't have as many reasons to itemize anymore.
Exactly.
Then we have the donation section. Donation is going up from 50% to 60% of the AGI.
Okay.
So up
So
until,
government wants you to donate more money.
well, the charities are getting affected. Charities are complaining that people wouldn't donate because they are not going to get deduction. If I'm not itemizing, I can't claim the charitable deduction.
Correct.
Nobody was donating 50% of their total income anyway. So if I say, if somebody is making $100,000, they were not donating $50,000 to begin with. So what's the point of increasing the 50% to 60%? It's not helping.
Acha.
But if people are not itemizing, they are not being able to claim the charitable deduction.
They're not getting benefit out of it.
So a lot of people will not be incentivated, will not be motivated to donate to the charities. So charities are not happy about it. Now coming back to what's not deductible anymore, a lot of itemized deductions, and our viewers can see the complete list over here. A lot of expenses that had the 2% floor, anything over 2% of the AGI were deductible. For example, the investment expenses.
Ji.
For example, the job-related unreimbursed expenses.
Ji.
All CPA fees, your tax prep fees, all these expenses are not deductible anymore.
Acha.
Working from home expenses, home office expenses, not deductible.
Really? Home office expense
Absolutely.
completely 100% gone?
Absolutely.
Because before they used to have that, what portion or what percentage of your home is that you use for the office. And a lot of small businesses, whether it's a doctor's office or CPAs, any other businesses, they use a certain portion of their home as their office.
Well, for the businesses, this is still allowed.
Correct.
If
But
you have a
individually
job,
not allowed.
if you have a job, a lot of people were able to claim, I work from home for a day. I use this corner in my house for my job-related purpose. I work on Fridays on home.
For example, a lot of people in IT industries.
Absolutely, that's the section we're talking about.
Okay, and that's not going to be deductible
That's
anymore.
not deductible going forward.
Achha. But for businesses, it's okay.
It's different.
Achha.
But,
Okay.
but I'm glad you asked. For the businesses, even the property tax is deductible 100%. So the deductions that we're talking about, the SALT deduction, all these itemized deductions that are not claimed, they're for individuals only.
Okay, interesting. Okay, anything else in the itemized deduction category?
Well, tools and supply,
Achha.
job search expense, all those, moving expense is a big deal. People used to claim moving from this state to that state,
That's completely gone?
not claimed anymore.
Oh my God, really?
Yep.
That is that actually big expense. Unless company pays for it, then it's a different thing.
Well, if the company pays for it,
It's
they
income to
have
you.
to report it as the income
Income to you.
in order to deduct it.
Okay.
If the company is not reporting the moving expenses paid for an employee as an employee's taxable income, the company does not have the right to claim that expense.
So we're not going to hire a movie company anymore. We're going to call our buddies and then move from one place
guess.
to another place. All right. That reminds me one more question before we go any further. In the medical expense, medical deduction rather, right? I'm sure there are many viewers, they really take advantage of it. You say 7.5% now, and then from next year it will be 10%.
10%, right. So for medical deduction for 2017 taxes and 2018 taxes, it was 7.5% of the total AGI. If somebody is making $100,000, any medical expense over $7,500, more than 7.5% is deductible for them. But starting January 1st, 2019, for 2019 year, the limit is going up to 10% of the AGI.
Okay, 10% of AGI. Okay, as we almost come to an end of the this show right now, and I just want to ask you a question. When it comes to this medical expenses, obviously you need to have your bills and everything, and hospital bills in order to claim deduction.
Right.
But let's say people who are working, and that includes me in the category, and if your co-workers are driving you crazy and nuts, is it deductible? Can you come up with a certain amount? Can you take deduction on
Well,
it?
I'm glad you asked. A lot of people ask me, I work for this charity.
Yes.
I make $25 an hour.
Correct.
Can I claim the 2 hours that I spend on the charity as charitable?
It's a fair
deduction?
question.
It's a fair
It's a
question.
fair question.
But the time is not allowed as a charitable
So
deduction.
basically, co-workers who gives you a hard time, you really can't
not
claim them in a
deductible.
medical expense deduction
Nope.
category. All right. With that note, we come to an end of the show. But before that, listen, you mentioned about businesses and whatnot.
Absolutely.
To start our own business and to be an entrepreneur is one of the most exciting things here
Absolutely.
in USA. So in the next episode, we're going to talk about that if you're going to be starting your business, what kind of company you should set up,
Absolutely.
whether it's a C corporation, S corporation, LLC, corporation or whatnot. So I guess with your help, at least we can give out so much information to our viewers.
So US allows 5 different type of companies, right? From the proprietorship to the partnership to the LLC, S Corp and C Corp, and every type of company has some advantages, some disadvantages. In our next
So
episode,
we're going to talk in detail on
we'll
that.
talk about what
Okay.
the pros and cons are
Very
and
nice.
what kind of structure makes sense for what type of business.
Okay, and I'm sure Ajay Kumar will find a time in his very hectic and busy schedule to come up with that information. I almost guarantee you with that. I mean, we'll be back same place, same time next week. This is the A Tax Time. Your taxes matter. I'm Sanjeev Pandya, wishing you all happy tax-free week ahead.